Hi again, students. This is session 3, part B. In session A, we dealt primarily with establishing the cost of the business combination to the acquirer. In this session, we will deal with establishing the fair value of the assets and liabilities being acquired by the parent. So, the acquirer shall at the acquisition date, allocate the cost of a business combination by recognizing the acquiree's identifiable assets and liabilities. We won't deal with provisions for contingent considerations, okay? But the point is here basically that the parent company needs to identify and measure all the assets and liabilities of the company being acquired, essentially the subsidiary company. So example 4 deals with this was. So example 4 has the following. So it says Disney Limited acquired all the assets and liabilities of Painting Limited on the 1st of January 2013. Disney Limited examined the assets and liabilities of Paintings Limited and found the following. An unrecognized trademark to the value of 40,000 Rand. So, in accordance with paragraph 36 of IAS the 8 intangible assets, Paintings would not have recognized the trademark because the asset would have been internally generated. So this is where it's important to understand and identify the fact that in terms of a business combination, the parent company needs to identify all unrecognized assets and measure them as well. So the question is, should the 40,000 Rand be included as part of the cost of the fair value of the assets and liabilities acquired by Paintings Limited? And the answer is yes, it should. It should be recognized as an intangible asset at 40,000 Rand added to the rest of the assets of Paintings Limited. So let's get back to our slides quickly. So what is the recognition criteria? Assets, that has to be probable that we will have future economic benefits and we can measure the fair value reliably. Liabilities, it must be probable that there will be an outflow of resources and the fair value can be measured reliably. Intangible assets, contingent liabilities, the fair value can be measured reliably. That's the only requirement. We won't deal with provisional values, so we will skip this, but essentially, if we cannot reliably estimate the fair values at the date of the acquisition, we are allowed to use provisional values that we must adjust within 12 months after the acquisition date if they are materially different. Contingent liabilities, we won't deal with this either at this point in time. We'll get to goodwill. We spoke briefly earlier about goodwill in our conceptual framework mapping. We spoke about measuring the cost of the acquiring entity and then measuring the fair value of the assets acquired by the parent. And we said these two amounts are used to calculate the goodwill or the bargain purchase at the date of acquisition. We further said that goodwill should be recognized as an asset in the consolidated financial statements and the bargain purchase should be recognized as income immediately at the date of acquisition. Let's continue quickly. So it says basically that when we pay more than the fair value of the assets we are acquiring, we pay a portion of goodwill. The acquirer shall at the acquisition date recognize goodwill acquired in a business combination as an asset. Initially measure the goodwill at its cost. So goodwill is basically defined as the future economic benefits arising from assets that are not capable of being separately identified and separately recognized. Example 5 has this for us. So it says basically on the 1st of January 20x5, SMEA acquired 100% of equity interest in SMEB in exchange for cash of 3,000 Rand. The fair value of SMEB's identifiable assets acquired and liabilities assumed. Importantly, identifiable assets and liabilities at fair value are as follows. No contingent liabilities exist. Equipment, inventory, accounts payable, accounts receivable, patents, fair value of assets acquired, less the accounts payable, which gives us the fair value of the net assets acquired of SMEB. So the question is, how much have we paid to acquire this company? We paid 30,000 Rand. And essentially, we're only receiving a fair value of 27,000 Rand, which means that we have overpaid by 3,000 Rand. And that excess payment is what we refer to as the goodwill that needs to be recognized when we prepare the consolidated financial statements. And that goodwill will be measured initially at cost and then subsequently amortized if we consider that it has a definitive useful life. If it has an infinite useful life, we leave it at cost and we have to do annual impairment testing. Going back to our slides quickly. So now we have what we refer to as negative goodwill, bargain purchase. So essentially a bargain purchase comes into existence when the fair value of the consideration that we pay for the investment is lower than the fair value of the assets we are acquiring. So let's look at example 6, which deals with this for us. Example 6 says the following. At 1st of January 2005, SMEA acquired 100% of the equity interest in SMEB in exchange for cash of 25,000 Rand. The fair value of SMEB's identifiable assets, liabilities, and contingent liabilities was measured as follows. Equipment, inventory, accounts receivable, patents, total of assets, liabilities, and we have a net asset value of 27,000 Rand acquired by the business. So the question becomes, how much have we paid for this? We have only paid 25,000 Rand. So we've paid 25,000 Rand for the investment, but we're receiving 27,000 Rand worth of assets. So this is referred to as a negative goodwill or a bargain purchase, which is the excess of 2,000 Rand. So importantly, the accounting treatment of a bargain purchase at acquisition date is that the 2,000 Rand needs to be recognized as income immediately in the consolidated financial statements. So it's not recognized as a liability, it's recognized directly as income. So let's go back to our slides quickly. So we've basically covered all of the important aspects of business combinations over these 3 parts. I recommend that you work through these examples and attempt the tutorials properly, and you should be more than adequately prepared for any assessments that you will receive in the future.